Corporate bankruptcies are currently on the rise worldwide, and experts are getting worried that this time it could be way worse than the usual ups and downs of capitalism. According to analysts, the real trouble here is that companies of different sizes and different locations across the globe have raked in enormous amounts of debt over the past few years. And with central banks in their countries raising their interest rates too, many of these companies won't be able to pay back what they owe. This spells danger for the global economy, because even though only about 15% of the massive $600 billion distressed debt floating around has defaulted, there is still $500 billion at risk of going down the drain. Richard Cooper, one of the preeminent cross-border bankruptcy and restructuring lawyers in the United States, who works at Clearly Gottlieb, knows all too well about the alarmingly high number of bankruptcies happening. He's seen it all, from the global financial crisis to the COVID-19 mess, and guess what? He's reported seeing it again this year, with corporate bankruptcies piling up at the second fastest pace since 2008, just behind the crazy times at the start of the pandemic. Also, according to Bloomberg, there's already a storm of over $500 billion worth of corporate debt distress brewing worldwide, and it will likely get worse. Currently, Wall Street is reportedly freaked out about it, because this debt could not only slow economic growth, but also strain credit markets that are still recovering from significant losses. Now, at first glance, the debt distress initially looked like the usual business cycle. You know, debts rising because of companies struggling with tech changes or remote work trends. But underneath all that, analysts have discovered a more troubling issue. These loads of debt piled up when money was super cheap. And now that interest rates are going up, and they're likely to stay up for a while, these debts are becoming a severe burden. The rising debt distress is partly by design though. Apparently, central banks got caught off guard by inflation and are now trying to slow down the economy by tightening credit to businesses. But we all know what that means too. Some companies will have to go belly up, so it's a challenging situation all round. In the meantime, the crazy level of corporate debt the global economy has dealt with recently has also raised the question of how dicey those pockets of corporate credit really were at the time they ballooned. Companies were reportedly receiving big credits during the years of rock-bottom interest rates, and back then, even struggling companies could easily borrow at the time to avoid facing the idea of closing up. For instance, in the US, high-yield bonds and leveraged loans owned by riskier businesses more than doubled from 2008 to a whopping $3 trillion in 2021. And that was before the Federal Reserve started raising rates at a high level. Over in China, the debts of non-financial companies shot up compared to the size of their economy, and junk bond sales in Europe skyrocketed by over 40% in 2021 alone. Many of those debts are coming due soon, adding up to a staggering $785 billion wall of debt. Now, with growth cooling in China and Europe and the Federal Reserve continuing to hike interest rates, some businesses will need help to handle these repayments. The Americas, for instance, are already witnessing a surge of troubled bonds and loans, up over 360% since 2021. And if this keeps spreading, the global economy will need to brace itself for the first widespread defaults since the Great Financial Crisis. This is all traceable to the notion that the current corporate debt storm is like an elastic band. You can stretch it only so far before it snaps. And as a matter of fact, we're already seeing it start to happen, with over 120 major bankruptcies in the US alone this year. Still, only less than 15% of the nearly $600 billion debt distress trading has defaulted globally. But as already mentioned, there's also a chance that some companies owing more than $500 billion might struggle to repay it, or maybe not able to repay it at all. Moody's is already predicting the default rate for speculative grade companies worldwide to rise to 5.1% next year, and in a worst case scenario, it could shoot up to 13.7%, beating the 2008-2009 credit crash. Now, although the situation does look gloomy because there's some uncertainty hanging around, the US economy has fortunately been surprisingly resilient, and inflation is slowing down there, which might indicate a soft landing for some companies. As well as this, yield spreads in the US junk bond market have narrowed since March of this year, so not all hope is lost. But still, we must recognise that even a tiny increase in defaults would create more problems. For instance, if defaults rise, investors and banks might tighten their lending belts, causing more companies to face distress as financing options vanish. And that could lead to more bankruptcies, affecting the job market and consumer spending. For example, in London's Canary Wharf, things could be looking better. Big banks like HSBC have been scaling back on office space, and remote work is speeding up the process. This area in East London is facing a rough patch, with some buildings being taken over by receivers due to missed loan payments, and HSBC plans to leave by 2026, causing more headaches for the developer, Canary Wharf Group, which already saw its credit rating drop as vacancy rates rose and retailers struggled. They currently have over £1.4 billion of debt coming due very soon. The commercial real estate sector is also taking the biggest hit, thanks to the slow return to offices. Out of the overall global debt, distressed debt tied to real estate is more than $168 billion, the highest among all sectors. China's real estate bust is also a big culprit, with companies like China Evergrande Group restructuring their debt, and the prices of others like Dalian Wonder Group Co. and Country Garden Holdings Co. tumbling down. Even the mighty WeWork Inc. in the US, with all its losses since its initial public offering, has bonds due in 2025 that yield around 70%. In dealing with these hits, Canary Wharf Group is reportedly trying to diversify its market by attracting life science companies and building more residences in East London. But investors seem unsure, as one of their bonds is being traded at just 68% of its face value. Quite the rundown, all things considered, but there have been reports of a potential solution for the global economy. Let's look at what analysts have dubbed the buyout game, and how it ties in with the corporate debt storm. Of all the types of companies involved in the debt distress, private equity firms have had it pretty easy with the level of credit they've gathered over the years. Their playbook was simple: find a company, buy it up, borrow tons of money from Wall Street, and then start slashing costs to rake in the profits. But here's the problem: those companies they bought up often ended up in serious debt, especially with those pesky floating rate loans. When the Federal Reserve kept interest rates super low, it was smooth sailing for these private equity firms. They didn't even bother to hedge their bets against the possibility of increasing rates. But rates have risen, and now these companies are in deep trouble. Over $70 billion of debt from companies owned by these private equity firms are in dire straits. Take Shutterfly, for example. They're an online photo printing company that got snatched up by Apollo Global Management for a hefty $2.7 billion, most of which was financed through debt. When they refinanced in 2021, they had an interest rate of around 5%, and everyone thought things would improve. But then inflation hit, cash flow tanked, and their loan rate skyrocketed to 10%. There are more companies in hot water too. Odyssey Incorporated, one of the big radio station owners in the US, has over $800 million in debt due soon. They slashed their expenses, but with the economy slowing down, they might need to restructure their debt in the coming months. And then there's the French grocer Casino Guichard Perrochon SA. They went on an acquisition spree to expand their empire, but it backfired when the pandemic hit. Their tourist-heavy locations suffered during lockdowns, and price hikes didn't help either. Debt piled up, and now they're in deep trouble. A Czech investor might just swoop in to take control and bail them out. We don't know. We'll have to wait and see. So these are some examples of companies feeling the heat of the ongoing debt storm. It's not looking too good for these companies, and the global economy either. How will they be able to handle this debt drama successfully? Stay tuned to find out on this channel. In the meantime, if you enjoyed running through this video, leave a like and subscribe to the channel. We post videos on trending news in the global economy space, and you wouldn't want to miss out on one of those. Also, leave a comment below letting us know your thoughts about the situation and your predictions for the future. Until next time, stay informed and take care.